في الهند. Allow me to welcome on stage Mr. Amar Raghu, Chief Executive Officer of Marmur Mean Intelligence, the research arm of Markaz.
A very good morning to all of you, and Happy New Year 2023. I want 2023 to be really happy because 2022 had all these issues. So my presentation is a very brief one. I'm going to set the stage for the riveting panel discussions that is going to follow that will focus on asset class. But my job here is to give the big picture of what's happening. 5 things happened. Among many, I would pick 5 that really shook financial markets in 2022. Number 1, Fed increased rates. What normally takes about 3 years for this quantum of increase took just 1 year for Fed. That's a defining moment. The dollar strengthened ferociously, not only in 2022, but also in 2021. Again, this is something that we haven't witnessed in the past. Both major asset classes, equities and bonds, fell together. We all know that asset allocation is always meant to balance risks, and 2022 is a year where we were having no place to go and hide. Both bond markets and stock markets had a synchronized fall. The fourth one, energy. Of course, the energy markets went into a big problem thanks to Russia. And there were supply factors, there were demand factors, there were geopolitical factors. Of course, the region benefited from good oil price, but there is a big question mark on how deep this energy crisis can go. And finally, of course, we know that the broader index fell, but what is more concerning is all the big tech companies, starting from Amazon to Apple, fell big time. We all have very big exposure to these tech stocks, either in the form of the primary index or directly. And here is a question that I'm asking: will they get their mojo back in 2023? So I'm going to just spend my time answering these 5 questions, which will probably lay the foundation for the outlook for 2023. Let's start with the Fed. As we can see here, from 0 to 4.4, it was like a steep increase. And the question is this the end of the story? Are we going to see Fed stopping increasing interest rates? We are almost there in terms of the rate hikes. We still expect about a couple of more hikes during the first half of 2023, and then there is going to be a pause. And the pause will last likely 2023, and then if at all Fed is expected to reverse course, which means reducing interest rates, that is likely to happen only by 2024. So what does that mean? It means cost of money will continue to be high throughout 2023, and that will run through many of the decisions that we are going to be making. Remember, we are never used to high cost of money for the last 1 decade. We have been fed 0 interest rates, and that's the mindset. We need to have a new mindset to think about a 5% interest rate lasting 2023. So obviously there are factors that can impact this decision, and most importantly, inflation. We all know that inflation went out of control in US and Europe and globally to an extent, though not so much in emerging markets, but things are cooling down a bit on the back of slowing down food price and energy price, but still the core inflation continues to be high. There are factors that make me think that inflation can remain high. There are also factors that make me think that inflation can cool down, but the call now is that inflation will determine the behavior of federal interest rates. So to answer the question, when will Fed pivot? Pivot meaning when will they start reducing interest rates? Not before 2024, and gone are the days when we have easy money. Money is going to cost a lot. This is probably the view from most of the investment banks that I have seen, and they all seem to think along the same lines. The second question about the dollar strength. Dollar has been extremely strong during the last 2 years against almost all major currencies. If you can see the graph on the right, it's the trade weighted index, and you can see that it always has a wave. And you can see that the current wave has gone through some extraordinary strength. Now, what can happen to the dollar is a very important question. On the factors that can keep the dollar strong would obviously be the Fed increasing the rates, which I said that we are expecting Fed to increase at least during the first half of 2023. So at least up to first half of 2023, we will see dollar remaining strong. And also there is a recession fear in US. Europe is already in recession, and that will mean flight to safety. That means dollar will remain strong. And on top of that, you have geopolitical concerns. So these are the factors that are likely to keep the dollar strong. But what can weaken the dollar? Obviously, when Fed stops increasing the rates, when they see inflation cooling down, obviously that will something that will weaken the dollar. And also, if you don't see too much of drama on the geopolitical side, that can obviously, it's high time dollar loses some of its value. And the general consensus is first half of 2023, dollar will remain strong, and thereafter it will start weakening. Coming to the most important question about equity and bond markets, how is it going to be for 2023? Let's take equity markets for a start. S&P 500 is currently about 3,970 levels. Most of the forecasts, around 15 managers, on an average, think that S&P 500 would be up by about 2.5% for 2023. Very close to what we already have, but there is a lot of variation between that average. The bullish call on S&P 500 is a 13% upside. Of course, you have the low base effect to help you, and the bearish call is a minus 14% downside. Remember, the equity market drawdowns can be much longer than what we anticipate, and therefore we are quite confused as to what is likely to happen. Now, what is likely to happen depends on three factors: how the recession is going to play out. Right now, there are three interesting scenarios possible. Number one, you have a hard landing where you have a recession that is deep and long. Then you have a soft landing. That means you have a recession that is not deep, not long. And then you have a very good scenario where there is no recession, life is happy after that. So we don't give much of a probability to both the pessimistic and optimistic scenario. I would personally stick with the middle scenario, which is moderating inflation and mild recession, in which case the consensus forecast must do. But what about fixed income? Fixed income, for the first time in the 40-year history of the bond markets, fell the steepest, and that too along with the equity markets. That is because of the very steep increase in the interest rates. Now, we are talking about the 10-year US Treasury yield, which currently is about 3.5%. The bullish call is 3.25 from Bank of America, and the bearish call is from Goldman Sachs at 4.3. The truth must be somewhere in between. So definitely, as I said, the bond markets will experience a further interest rate hike, which might lead to losses, but that's only up to the first half, and then the bonds are likely to do well after that. Energy is a very important question for the GCC. We have had some good oil price to support the fiscal side of the story. And again, how energy is going to play out will depend on what type of a recessionary scenario is going to unfold. But the beauty is, normally it's good if energy behaves in a sweet spot, which means we don't want a $20 oil price, we don't want a $150 oil price, we want something in between, and that exactly is what is likely to happen even under all the three scenarios. In the worst scenario, when you have harsh landing, we expect oil price to behave between $90 to $110. In the normal scenario, it will be about $115. In the best case scenario, it can go up to $150. But as again, everything depends on probability. I would pitch my probability more to the central scenario, which is what the experts in the industry also look at. This is all, of course, a confluence of a lot of factors that influence demand and supply, and that's a separate topic by itself. And finally, the tech world, or what I call as the big tech. If you can see, big tech had a fantastic run in the last 1 decade, primarily on the back of certain aspects. The number one, of course, is that they focused on what is called as mobile internet services, which depends on 3S, which is shopping, search, and social media. Now, that 3S is probably showing some signs of exhaustion. Also, these big tech companies got into extremely high valuation, primarily on the basis of easy money. Now, there is a view that big tech days are gone. Earnings are going to come under severe pressure because of law of large numbers. Regulatory focus on these big tech companies are extremely severe, and competition is very intense. So, is it moving to the next wave, which is called the digital tech, that can influence industries like biotech, healthcare, and manufacturing? And these are not dependent on customers like how the 3S was dependent. Therefore, if it is going to be a structural shift that is happening in the industry, then you're not thinking about the mojo coming back. Remember, these guys are market leaders with tremendous market share. And therefore, that question begs a very important answer. Maybe we are in an age where things are structurally shifting. So that's the quick analysis on the 5 questions. In terms of how does it look for GCC, the numbers are looking great from an economic perspective. The GDP is going to slow down a bit, but not very badly. It is still 2023 will be a year with good GDP growth, especially on the non-oil side. The fiscal break-even oil price, it's the oil price that you need to balance the budget, is still very, very low compared to the current oil price. And therefore, even with the lower oil price, most of the GCC economies will break even. And then we have inflation that is moderating, which is also very good news. So on the economic side, the GCC markets are looking good. If you look at the performance of the GCC equity class, 2022 has been reasonably okay. Kuwait is the 3rd best performing market. Of course, Abu Dhabi and Dubai topped the list. And then you have GCC bonds on the bottom. On the global side, of course, it will be a year where growth will slow down. Inflation will also slow down. But it's a big question mark as to whether this will technically lead to a big recession. And you can see how the asset classes have performed globally for 2022. Almost everybody is negative, and it's of course a very confusing picture if you look at the long term, and that's where the importance of asset allocation and market selection comes into play. So with this, I will close my presentation and back to Abdul Latif. Thanks for a very patient hearing. Thank you.